Slide 1, ITC Limited, Full Fundamental plus Technical Analysis. Welcome back to the channel. Today we are doing a complete, no-fluff, data-driven breakdown of one of the most controversial and most debated large-cap stocks on Dalal Street right now, ITC Limited. This is April 2026. ITC is trading at around 290 rupees per share, and it has fallen a massive 36% from its post-demerger price of 455 rupees back in January 2025. That is a steep, prolonged decline for a company that most people consider fundamentally strong. So what is really happening here? Is this a value trap or a value opportunity? We are going to go through the fundamentals, the technicals, the business segments, the valuation models, the scenario analysis, and the key risks, so that by the end of this video, you have every single data point you need to form your own view. This is a 113-year-old company. It has survived world wars, recessions, GST overhauls, and multiple excise duty cycles. And today it sits at one of its most interesting inflection points in recent memory. Let us get into it. Slide 2. Company Snapshot. ITC at a glance. The numbers that matter. Let us start with the basic snapshot, because these numbers alone will raise some very interesting questions. Current market price, approximately 290 rupees. Market capitalization, roughly 3.6 lakh crore rupees, making ITC one of India's largest FMCG conglomerates by market cap. Now here is where it gets interesting. The 52-week high was around 530 rupees, so the stock is sitting nearly 45% below its 52-week high. That is a significant drawdown for a Nifty 50 blue chip. But look at the quality metrics. Dividend yield, 4.9%. That is the highest dividend yield in the entire Indian FMCG universe. Higher than Huel, higher than Nestle, higher than Britannia. And ITC has maintained a dividend payout ratio of 78.6% of profits. 3-year average return on equity, 28%. Return on capital employed, approximately 27.3%, and the company is near debt-free. These are exceptional numbers for a diversified conglomerate. A 28% ROE with near zero debt is something you typically only see in the best businesses in India. And yet, the stock is sitting at multi-year lows. That contradiction is exactly what this video is about. Slide 3. Revenue and profit, reading the right numbers. Before we look at the charts, there is one crucial point I want to make, because if you read ITC's FY25 numbers without context, you will completely misread the company. Revenue has grown steadily from 423 crore rupees in FY21 to 809 crore in FY25. That is a compound annual growth rate of approximately 7.2%. Solid, consistent growth. But look at PAT in FY25. It shows 35,356,100,000 INR. That number is massively inflated. It includes a one-time gain of approximately 15,700 crore rupees from the ITC Hotels demerger. This was a non-cash, non-recurring accounting entry. Strip that out and normalized PAT growth is a much more modest 8 to 10% CAGR. Still respectable, but very different from what the headline number suggests. Now for FY26 estimated revenue, the number drops to approximately 73,500 crore rupees. Before you panic, this is not a sign of operational deterioration. This is purely because ITC Hotels revenue is no longer being consolidated into ITC's books following the demerger. It is a structural change in reporting, not a business decline. This is a critical distinction. When analysts compare FY26 revenue to FY25 on a like-for-like basis without adjusting for the hotels demerger, they are comparing apples to oranges. Always adjust the base before making year-on-year comparisons. Slide 4. Revenue Trend Chart. 7 years of steady growth. This bar chart tells the story of ITC's revenue trajectory from FY21 through to our FY26 estimate. Starting at 56,400 crore in FY21, then 62,600 in FY22, then 69,400 in FY23, then 73,900 in FY24, reaching a peak of 79,800 crore in FY25. And then the FY26 estimate at 73,500 crore. Now that FY26 dip is the single most misunderstood data point in ITC's recent financial history. Every analyst who covers ITC will tell you the same thing. You must strip hotels out of the FY25 base before you can make a fair comparison. On a hotels excluded basis, the underlying FMCG, cigarettes and Agri segments are all continuing to grow. the underlying business is not shrinking. The reporting base has changed. Those are two very different things. Keep that in mind as we move through the rest of this analysis. Slide 5. Business segments. One engine powers the entire train. ITC now operates 4 core business segments post-demerger. And here is the single most important insight for understanding this company, an insight that surprises almost everyone who looks at ITC for the first time. Cigarettes contribute just 47% of total revenue, but they contribute a staggering 85% of total EBIT, earnings before interest and taxes, the profit engine. The remaining 3 segments, FMCG Others, Agri Business, and Paper and Packaging, together contribute 53% of revenue, but generate only 15% of EBIT. That is a massive margin disparity. FMCG Others, which includes brands like Sunfeast, Savlon, Yippee Noodles and Ashirwad Atta, contributes 26% of revenue, but only 6% of EBIT. Agri Business is 18% of revenue and 5% of EBIT. Paper and Packaging is 9% of revenue and 4% of EBIT. This concentration is both ITC's greatest strength and its most debated vulnerability. This strength, cigarettes generate enormous, consistent, high-margin cash flows that fund everything else. The vulnerability, if cigarette volumes ever structurally decline, the entire earnings model gets disrupted. This is why understanding the cigarette segment in depth is absolutely essential to understanding ITC. Slide 6. Cigarettes, the irreplaceable cash engine. Let us talk about cigarettes, the business that most institutional investors love to hate but cannot afford to ignore. In Q1 and Q2 of FY26, ITC's cigarette volumes grew 6 to 6.8% year-on-year. That is well above the historical average of 2 to 3%. This outperformance was not driven by Indians suddenly smoking more. It was driven by market formalization. Here is the dynamic. India has a massive informal tobacco market, biddies and illegal cigarettes. As regulatory enforcement tightens, consumers are switching from unregulated, informal tobacco products to ITC's branded regulated cigarettes. ITC captures this formalization as volume growth, even in a tightening regulatory environment. Now, the biggest structural risk to this segment, excise duty. The union budget for FY26 hiked cigarette excise duty by 7 to 8%, the steepest increase since 2017. This was the primary trigger for the stock sell-off. When this hike was announced, the market immediately repriced ITC lower, because the fear was that higher prices would cause volume declines. But here is the paradox. Despite the hike, volumes actually held up and continued growing. That is a powerful demonstration of the inelastic demand for cigarettes and the strength of ITC's market position. The bear case for cigarettes has not materialized, at least not yet. Slide 7. FMCG Others, the long-term value unlock. Now let us talk about the segment that could potentially re-rate ITC's valuation in the coming years, FMCG Others. In FY15, this segment generated approximately 7,500 crore rupees in revenue. In FY26 estimated, it is approximately 19,000 crore rupees, that is a 2.5 times expansion over a decade. Brands like Ashirwad, India's #1 branded Atta, Savlon, Yippee Noodles and Sunfeast biscuits are all gaining meaningful category share. But here is the problem, and it is a significant one. Despite 26% revenue contribution, FMCG Others generates only 6% of total EBIT. The operating margins in this segment remain sub 10%. For context, UL runs FMCG margins of over 22%. Nestle India runs even higher. ITC's FMCG margins are roughly half of its best-in-class peers. This gap is what analysts call the margin compression story. ITC is investing heavily in brand building, distribution and capacity to scale FMCG. The thesis is that as the segment scales, operating leverage kicks in and margins expand. The re-rating thesis is this: for every 100 basis points improvement in FMCG EBIT margin, ITC's blended valuation multiple should expand. The question is not whether this will happen. The trajectory is clear. The question is when. Slide 8. The cheapest FMCG stock in India. Let us now move into the valuation chapter, and this is where the ITC story gets really compelling from a fundamental standpoint. At approximately 18 times normalized earnings, ITC trades at a 58% discount to the Indian FMCG sector average of approximately 43 times PE. Let that sink in. The largest, most profitable, most dividend-paying FMCG stock in India trades at less than half the sector multiple. We ran 3 independent historical valuation models to triangulate fair value. First, EV2 EBITDA, median model fair value 452 rupees. Second, EV2 sales median model fair value 551 rupees. Third, price to sales median model fair value 549 rupees. All three models converge above 450 rupees. The median intrinsic value across all three models, 549 rupees per share. The 12-month analyst consensus from sell-side research houses sits at 440 to 510 rupees. That is a 52 to 76% upside from the current price of 290 rupees. Now, the discount exists for a reason. The cigarette business attracts ESG exclusions from global institutional investors. The hotels demerger created temporary uncertainty about ITC's growth profile. And the excise duty hike weighed on sentiment. These are real factors. But the gap between where the stock trades and where fundamentals suggest it should trade, that gap is historically wide. Slide 9. ITC vs FMCG peers. The discount in numbers. This chart makes the valuation gap impossible to ignore. Let me walk you through the PE multiples of ITC versus its FMCG peers. ITC, 18 times earnings. Hindustan Unilever, 52 times earnings. Nestlé India, 68 times earnings. Britannia Industries, 44 times earnings. Dabur India, 38 times earnings. Marico, 42 times earnings. ITC's 18x PE is not just a discount, it is what some analysts are calling a generational anomaly. At 18x, ITC trades cheaper than it did in the early 2000s, a period when the company was far less diversified and far less profitable than it is today. The combination of ESG stigma, demerger overhang and FII selling has created a valuation gap that fundamental investors find difficult to ignore. The question is not whether ITC deserves a higher multiple. By any reasonable fundamental standard, it clearly does. The question every investor has to answer for themselves is, what is the catalyst that will close this gap, and when will it arrive? Slide 10. Key financial ratios. Let us look at the profitability metrics over time, because these numbers reveal some important nuances. EPS in FY21 was 10 rupees and 84 paise, FY23 15 paise, FY24 16.39 paise. FY25 reported at 28.15 paise, but as we discussed, this is inflated by the hotel's demerger gain. Normalized EPS is approximately 16 rupees per share. ROE has been remarkably consistent, 22.4% in FY21, rising to 30% in FY23, and remaining at approximately 27 to 28% in FY24 and FY25. That consistency in ROE across a diversified conglomerate is genuinely exceptional. Current P, at approximately 18 times normalized earnings. Price to book at 5.27 times. Now look at the dividend payout ratio trend. FY21 47%. FY23 39.7%. FY24 38.2%. FY25 is to 23.1%. This declining payout ratio is often cited as a red flag. ITC is paying less in dividends, but there is a more constructive interpretation. The declining payout ratio means ITC is retaining more capital for FMCG reinvestment. As the FMCG segment scales and requires more capex and brand spending, ITC is choosing to deploy cash into growth rather than distribute it all. For long-term investors who believe in the FMCG re-rating thesis, this is a maturity signal, not a red flag. Slide 11. Technical analysis, technically bearish. Let us now switch from fundamentals to the technical picture, and here the story is very different. Technically, ITC is in a clear, sustained downtrend. The verdict across all time frames: short-term, bearish; medium-term, bearish. Long-term, watch 310 rupees for any sign of trend change. ITC has been in a sustained downtrend since its post-demerger price of 455 rupees in January 2025, a decline of 36% over approximately 15 months. All major moving averages, the MA5, MA10, MA20, MA50, MA100, and MA200, are in a unanimous sell configuration. When all 6 major moving averages are stacked against a stock, it means there is no technical time frame where the trend is positive. RSI is in deeply oversold territory. Now, oversold conditions can persist for extended periods without a catalyst. Oversold alone is not a reversal signal, it just means the selling has been intense. Key support levels to watch: immediate support at 288. Strong support at 284. Critical support at 280, the 52-week low zone. A breakdown below 280 on high volume could trigger stop losses and accelerate selling toward 260. On the upside, 296 is the immediate resistance. Reclaiming 310 would signal a short-term trend change. The SMA 50 area at 350 to 360 would confirm a genuine medium-term reversal. And the SMA 200 at 390 to 410 represents full structural recovery. The weekly pivot sits at 292 rupees 35 paise. The technical picture is telling you the weight of evidence is bearish and patience is required before the chart gives a buy signal. Slide 12, 4 reasons ITC dropped 36%. So why has ITC fallen so dramatically? Let us be precise about the 4 factors. Reason 1, excise duty shock. The union budget for FY26 hiked cigarette excise duty by 7 to 8%, the steepest increase since 2017. This single event wiped out much of the volume growth optimism that had driven the stock above 530 rupees. The market immediately repriced ITC lower as analysts cut cigarette volume forecasts. Reason 2, ITC Hotels demerger overhang. On January 6, 2025, the ITC Hotels business was formally demerged and separately listed. Shareholders received 1 ITC Hotels share for every 10 ITC shares held. Approximately 26 rupees per share was effectively stripped away from ITC's intrinsic value on the ex-date. Institutional investors spent months recalibrating their sum of parts models, and during that recalibration period, selling pressure was persistent. Reason 3, FII ESG selling. Global FMCG funds operating under ESG mandates, particularly those that explicitly exclude tobacco companies, have been structurally reducing ITC positions throughout 2025 and into 2026. This is not a trading decision, it is a mandate-driven structural selling that has nothing to do with ITC's fundamentals. Reason 4, broader market dynamics. The nifty FMCG sector underperformed the broader market through FY26. As macro tailwinds favored rate-sensitive and infrastructure sectors, defensive FMCG names like ITC lagged cyclicals. This sector-level underperformance amplified the stock-specific headwinds. All 4 of these factors hit simultaneously. That is why the move was as large as 36%. Slide 13, Scenario Analysis, the May 5th moment. Now let us talk about what happens from here. And the most important near-term event is Q4 FY26 results, expected on May 5, 2026. This single earnings sprint, and the management guidance that accompanies it, will likely determine whether ITC re-rates toward fair value or tests the bear case lows. Let me walk you through the 3 credible scenarios. Bull case, 420 to 480 rupees. This requires Q4 FY26 to beat estimates, revenue above 19,200 crore, PAT above 400 crore. You need FY27 guidance showing 7 to 8% cigarette volume growth. The FMCG segment needs to cross 10% EBIT margin. FII buying would need to resume as the ESG debate evolves, and broader market recovery above Nifty 24,000. If all of these align, the stock has 45 to 65% upside from current levels. Base case, 320 to 380 rupees. Q4 in line with estimates, revenue 18,500 to 19,200 crore, PAT 5,000 to 400 crore. Cigarette volume sustained 5 to 6% growth despite the excise hike. FMCG grows 10 to 12%, but margins stay compressed. Stock re-rates from 18x to 21 to 22x normalized earnings over 12 months. Analyst consensus puts this at 440 to 510, but let us be conservative at 320 to 380. Bear case 240 to 270 rupees. Q4 misses significantly. Cigarette volumes decline 2 to 3%. Further GST tightening announced. FMCG stays sub 8% margin. Price breaks below 280, triggering stop losses. Potential flash toward 260. And if EPS normalizes at 14 to 15 rupees, there is even a dividend cut risk. 3 very different outcomes. All plausible. May 5th is the key date to watch. Slide 14. Scenario visualization, price targets. This chart lays out all the scenarios visually on a single horizontal axis, so you can see exactly where each outcome maps to in terms of price. At the far left, bear case ranging from 240 to 270 rupees. Current price 290 rupees. Base case 320 to 380. Bull case 420 to 480. And at the far right, the median intrinsic value from our three independent valuation models, 549 rupees. A few things jump out from this chart. First, even in the base case, there is 10 to 31% upside from current levels. In the bull case, 45 to 65%. And against the fundamental intrinsic value, 89% upside. Second, the bear case downside from 290 to 240 to 270 is 7 to 17%. So on a risk-reward basis, potential downside of 7 to 17% versus potential upside of 10 to 89%, depending on which scenario plays out. That asymmetry is what makes ITC such a talked-about stock right now. Third, the gap between current price and intrinsic value, roughly 89%, is historically wide for a company of ITC's quality and profitability profile. The market is pricing in a deeply pessimistic scenario that fundamental models do not support. I want to be clear, this chart shows scenarios and valuation models. It does not tell you which scenario will happen. The future is uncertain. But the data is the data. Slide 15. Key catalysts. What will move the stock? Let us talk about the specific catalysts that will determine which scenario plays out. Catalyst 1. Q4 FY26 results, May 5, 2026. This is the single biggest near-term catalyst. Not just the revenue and PAT numbers, but specifically the cigarette volume figures and the management commentary on FY27 volume guidance. Any positive surprise on FMCG margin improvement or cigarette volume acceleration will trigger a sharp re-rating. Any miss will accelerate the bear case. Catalyst 2. ITC Hotels performance. ITC retains a 40% strategic stake in the demerged ITC Hotels entity. Centrum Broking projects ITC Hotels reaching 45.7 billion rupees in revenue by FY27 at a 35% EBITDA margin. India's hospitality sector is in a multi-year upcycle driven by domestic travel and MICE tourism. This 40% stake continues to add to ITC's sum of parts value, and as hotel performance improves, the market will need to incorporate it more fully into ITC's valuation. Catalyst 3. Agri business volatility. Leaf, tobacco, wheat and spice prices directly impact agri-business margins in the Q3 and Q4 seasonality windows. A favorable commodity cycle could provide a meaningful earnings surprise from this 18% revenue segment. Catalyst 4. Budget FY27. Excise duty direction. Any reversal or stability in excise duty on cigarettes would be the single biggest stock re-rating event. The 7 to 8% hike in FY26 was the primary catalyst for the sell-off. Its unwinding or even moderation would restore volume growth confidence and force analysts to revise their cigarette volume estimates upward. Slide 16. The 25,000 crore rupees milestone that changes everything. There is one specific FMCG milestone that analysts are watching very closely, and it has the potential to be a significant valuation re-rating trigger. FMCG Others needs to cross 25,000 crore rupees in revenue with 12% or higher EBIT margins to justify a meaningful re-rating of ITC's blended valuation multiple. Where are we today? FY26 estimated FMCG revenue is approximately 19,000 crore rupees. The gap to the target is approximately 6,000 crore rupees. At the current growth trajectory, this is potentially achievable in 2 to 3 years. Why does this specific number matter? Because at 25,000 crore with 12% margins, the FMCG segment alone becomes comparable in scale to Britannia Industries' total annual revenue. At that point, the market can no longer ignore it as a small non-core business. It becomes a core business that demands a separate higher valuation multiple in any sum of parts analysis. Every 100 basis points improvement in FMCG EBIT margin from the current 8 to 9% level adds meaningful value to ITC's blended multiple. If the FMCG segment ever reaches HUL-like margins of 22%, a long-term aspiration, the segment alone would justify significantly higher PE for the consolidated entity. This is the 10-year thesis in ITC. Cigarettes generate the cash, FMCG absorbs it and builds scale. At sufficient scale and margin, FMCG re-rates the whole company. Slide 17. 5 facts every investor must know about ITC. Here are 5 facts about ITC that your viewers absolutely need to know, because most retail investors are not aware of at least 2 or 3 of these. Fact 1. ITC is cheaper than 1999. At 18 times PE, ITC trades at a lower multiple than it did in the early 2000s, a period when the FMCG segment was embryonic and cigarettes were far more dominant. The ESG stigma has created a historically rare valuation discount that long-term investors have seldom seen in a business of this quality. Fact 2. The FMCG in 10 years thesis. FMCG others grew from 7,500 crore in FY15 to approximately 19,000 crore in FY26 to 2.5 times in a decade. ITC is quietly building a parallel FMCG empire inside a tobacco company. It is now within striking distance of Britannia's annual revenue. Fact 3. Dividend machine 25 plus consecutive years. ITC has paid uninterrupted dividends for over 25 consecutive years. At 290 rupees current market price, the dividend yield of 4.9% exceeds most fixed income instruments. Investors are in effect being paid to wait for the stock's re-rating. Fact 4. The demerger math. Shareholders who held ITC received 1 ITC Hotels share for every 10 ITC shares. The combined value of ITC shares plus ITC Hotels shares at current market prices is still 15 to 20% below where ITC alone stood in 2024. The market has not yet given full credit for the combined entity's worth. Fact 5. The cigarette volume paradox. Despite the 7 to 8% excise hike, ITC's cigarette volumes grew 6% in FY26. This is because the market is formalizing. Consumers are shifting from unregulated bidi and illegal cigarettes to ITC's branded regulated products. Higher taxes hurt ITC's competitors more than they hurt ITC. Slide 18. Risk metrics. Now let us talk about the risks, because any honest analysis must give equal weight to the downside scenarios. ITC faces 4 distinct risk categories: regulatory risk, excise, and GST hikes. The government has used tobacco taxation as both a revenue tool and a public health tool for decades. A second consecutive excise hike in budget FY27 is the bear case trigger. If the government announces further tightening, it would directly compress cigarette volume growth and earnings. This is the single highest impact risk. ESG risk FII tobacco selling. As global ESG mandates become more stringent, tobacco-exposed companies face structural selling pressure. Foreign institutional investors, who are required to comply with ESG screens, cannot hold ITC regardless of its fundamentals. This creates persistent selling that is not responsive to positive news flow. Operational risk FMCG margin stagnation. If the FMCG segment cannot sustainably cross 10% EBIT margins, the entire re-rating thesis is delayed or invalidated. Consumer. Staples is a brutal competitive environment. UL, Nestle, Britannia, Patanjali and regional players are all competing for the same shelf space and consumer mindshare. Market risk, broader correction. A broader Nifty correction amplifies all of the above. Here is the key nuance. These bear case risks are real, but they are largely known and, at 290 rupees, partially priced in. The greatest risk is a second consecutive excise hike or a structural cigarette volume decline, neither of which is the base case expectation among sell-side analysts as of April 2026. Slide 19. ITC Hotels, the hidden asset in plain sight. Let us spend a moment on ITC Hotels, because this is an asset that is genuinely underappreciated by most retail investors. On January 6, 2025, ITC Hotels was formally demerged and separately listed on the exchanges. Shareholders received 1 ITC Hotels share for every 10 ITC shares held. ITC retained a 40% strategic stake in the demerged entity. That 40% stake is not trivial. Centrum Broking projects ITC Hotels, reaching 45.7 billion rupees in annual revenue by FY27 at a 35% EBITDA margin. India's hospitality sector is in a genuine multi-year upcycle driven by domestic travel growth, MICE tourism, meetings, incentives, conferences, exhibitions, and the recovery of corporate travel post-COVID. Now here is the market mispricing angle. The combined value of ITC shares plus ITC Hotels shares at current market prices is still 15 to 20% below where ITC alone was valued in 2024. In other words, the sum of the parts is worth less than what the whole was worth before the demerger. The demerger created temporary institutional confusion about the right valuation framework, and that confusion has not yet been fully resolved. Patient investors who understood this arithmetic at the time of the demerger have been waiting for the market to correct this mispricing. Whether it corrects through ITC appreciating, ITC Hotels appreciating, or both, The combined value should, in theory, at minimum equal what ITC alone was worth before the separation. Slide 20, Investment Conclusion. ITC at 290 rupees, where fundamentals and patience meet. Let us bring all of this together. ITC at 290 rupees is a stock where exceptional fundamentals meet maximum short-term pessimism. Near debt-free, 28% ROE, 4.9% dividend yield, the highest in Indian FMCG, 18 times PE, and a median intrinsic value of 549 rupees across 3 independent valuation models. The reasons to be constructive: 58% discount to FMCG peers, a 4.9% dividend yield with a 25-year track record, 6% cigarette volume growth despite excise hikes, FMCG nearing scale, near debt-free balance sheet. The key risks: further excise duty hikes, persistent FII ESG selling, FMCG margin stagnation, a break below 280 rupees on technicals, a Q4 results miss. The critical dates: May 5, 2026, Q4 FY26 results, Union Budget FY27, excise duty direction, and ongoing FY27 management guidance calls for FMCG margin roadmap. The road to re-rating runs through 3 things: May 5th results surprising positively, FMCG margin improvement crossing 10%, and excise duty stability in FY27. For investors with an 18 to 24-month horizon, the asymmetry between the downside risk and the fundamental upside is striking. The data says 290 is cheap on fundamentals. The chart says 280 is the last line of defense technically. What happens next depends on Q4 results and budget FY27. That is the complete picture on ITC. All facts, all data, you decide. If you found this analysis useful, hit the like button and subscribe. We will keep covering these deep dive analyses on all the major names on Dalal Street. See you in the next video.